Hey everyone, Douglas here. Welcome back to the MMT Macro Trader in this market research video. Listen, I think I have quite the video tonight lined up for everyone. We're going to be diving deep into macroeconomics. The goal of this video, the aim of this video, is to debunk the Austrian business cycle theory and also establish and understand the only empirically correct lens to view the macroeconomy through modern monetary theory and apply that to the current market conditions. Listen, this video is going to be long, probably going to cross the 30-minute mark. We have to cover a lot of topics. We have to cover a lot of data. We have to go very deep into understanding the dynamics that are at play in the macroeconomy to get to the ultimate answer that I want to get to in this video that kicked everything off with discussions that I've been having online with Austrian economists like Bob Murphy. Why does the yield curve invert prior to recessions? And why were MMTers like myself back at the end of 2022, while everyone else was calling for a recession, why were we calling for a boom, a better than expected expansion of the economy? That is really the goal. But in order to get to that goal, we are going to have to cover a ton. So again, to kind of set the stage here, Bob Murphy is a absolutely great guy. He's an Austrian economist. I disagree with him on almost every point when it comes to understanding the macroeconomy and applied economics. But with that being said, he's a great guy. He's absolutely willing to engage with any theory that comes his way. MMT certainly gaining a lot of steam over the last few years. He's been wanting to engage and understand the MMT framework, trying to debunk it on his own right. We've gotten into some back and forth on Twitter. A lot of this has been predicated on the fact that I've been taking a bit of a victory lap. I have been for some time now calling for, actually going all the way back to 2022, calling for a big rally heading into this year, not only in stocks, but a better than expected macroeconomy as a whole. This has effectively been the main MMT case that I've been making. And look, I've been calling out those who were claiming that we would see a recession. Bob Murphy was one of those. And admittedly, he's been willing to say that kind of the way that he phrased some things was not the best way. And so we've had a back and forth. He's still calling for a recession, maybe by the end of this year into Q1 of 2024. But he's been a good sport about it, willing to engage. And I think he wants to understand the MMT viewpoint. Obviously, he's an Austrian. He's going to fight his side. I love that. So we're going to get into it. That kind of sets the stage. That's where we're at. To a certain extent, this is going to be a response video directly to Bob Murphy and the Austrians. So, forgive me if I specifically mention by name, but to a certain extent, I do feel like after I've listened to a tremendous amount of Austrian economic theory over the last week or two, as I try and piece all this together, he's been in my ear. So to a certain extent, I'm responding directly to the stuff that he's been putting out recently, which really the main video where I'm getting, or at least going to kind of build the Austrian side from, is this video right here. Does the inverted yield curve signal a coming recession? This was put up a month ago. So I'm getting, this is kind of my source material, and then also a blog post that was posted in mid-2022, the last year this time, about the inverted yield curve and the recession. So let's do this. How I'm gonna set this video up. We are going to first kind of establish, to the best of our ability, steelman the Austrian business cycle theory, try and explain what it is that they're seeing, why they think that this yield curve inversion always precedes a recession. Then I'll kind of explain the MMT understanding of the business cycle. And then from there, once we have all the pieces in place, I think I can go back and debunk the Austrian business cycle theory. And along the way, we're going to look at a lot of data. We're going to have to get in the lab. We're going to have to we have to do some data science. It might get a little heady at some point, but I promise by the end of this, it'll be worth it. You'll have a deep understanding of the business cycle and the data that is pertinent. All right, let's get into things. Let's go ahead and kick things off with the Austrian business cycle theory. Here's effectively how the Austrians would see the business cycle theory. And the business cycle theory for them all kicks off with the Federal Reserve coming in and manipulating the markets, distorting the signals by lowering the interest rate artificially to zero. And it's when the Federal Reserve comes in and does this that you get an investment boom. This distorted market signal effectively ramps up the desire to borrow, and you get a boom in the business cycle of the Fed just stayed out of things. The signal that is sent via the interest rate to the private market would properly demonstrate to the private market what the actual appetite for risk is, where resources should be properly allocated. Probably not explaining it as nuanced as they would want, but that is my understanding effectively what they are saying. Eventually, this boom that occurs because of this artificially low, this manipulatingly low interest rate creates an unsustainable bubble. Along the way, the Fed might raise interest rates as maybe we get close to a recession, hoping to thwart any oncoming inflation or an economy that's going to get too hot. They raise these interest rates. In doing so, dramatically raising these interest rates, they collapse the ability for the economy to grow. They dissuade the demand from the expanding credit cycle, and that creates the bust that we inevitably see. And then there is a settling where resources are able to reallocate. So I hope I have, at the very least, properly set the stage for what the Austrian business cycle is trying to get across, and what I've at least understood in kind of a in a summary state what their argument is. So that's the Austrian business cycle. Like I said, what I want to do now is kind of look at the Austrian business cycle through the lens of modern monetary theory. Let's go ahead and explain modern monetary theory, and then we'll bring in the data after that and start to look at some things. So first things first, I think the first thing that we have to establish is everything that I just spelled out about the Austrian business cycle theory, I'm willing to, for the sake of the argument, say is a correct framework for understanding, a good starting point for understanding, if we were under some sort of fixed rate regime, if we had a gold-backed currency, if we pegged our currency to another currency. Their cycle probably does explain the business cycle to a certain extent, right? I'd have to dive into it deeper, but at the end of the day, it doesn't matter. And this is the absolutely the first error that sends us off on absolutely opposing trajectories, where the real world empirical data that we see will never represent what the Austrian business cycle is claiming happens. This is why when you look at the Austrian business cycle kind of guesses in terms of where the economy is going to go, they're not going to make any, and if they are, they're usually wrong. They've been right in the past. They have a bit of an understanding, a proper understanding of the boom and bust cycle from the credit side, but they massively get wrong the fiscal side of things because their starting point, where they begin, is with a fixed rate regime. But we are not in a fixed rate regime. In fact, this is where almost every monetary school goes wrong. We are in a floating exchange rate. This is why Warren Mosler, when he originally started what became MMT, called what he was doing soft currency economics. Everything needs to be reassessed. The dynamics at play need to be reassessed when you are in a floating exchange regime. And so that is the first thing that needs to be recognized from an MMT perspective. And if it's missed, if it's not understood, you're going to end up misunderstanding every possible dynamic at play because of that one variable being off right out of the gate. So most important thing out of the gate, we're in a floating exchange rate. Now look, that is a decision, right? That is a political decision. I'll even admit that. That is a political decision. There is no, I mean, if anything, the floating exchange rate probably is the natural existence of a monetary system. But you could, if you wanted to, decide to artificially constrain your spending. That is something you could do. I'm not going to argue against that. That's a possibility. My point is, since 1971, effectively, we've been in this floating exchange rate, and we have to do our macro analysis with that in mind, right? We have to take our empirical observations with that in mind. I'm not saying you couldn't have it a different way, but what I am saying is that today we are in a floating exchange rate regime, and you have to do your analysis. You have to build your macro framework with that in mind. And if you don't, you're going to make wrong assumptions, and you're going to get your calls wrong. On to the next point. I think I've made that point, but it's so important. I think I've made that point. So next up, I think what we can do is kind of look at, kind of similar to the Austrian business cycle theory, we can look at this idea of a business cycle from the MMT perspective. And I think where I want to start is with the kind of the most important thing in this entire sequence, and that's going to be government spending. I'm going to pull up a chart here of the federal deficit. This is pulled from the monthly treasury statement. It's the accumulated surplus or deficit adjusted for CPI. So it's the real surplus or deficit. And then we'll go through this, and then we'll also take a look at kind of every other data point that is important, pertinent going forward. Effectively, what the MMT argument is that when the government spends, that becomes private sector savings. That becomes net financial assets to the private sector. Under a floating exchange regime, when the government spends, by accounting identity, that is the private sector savings. That means something. There are quite a few things that means. One, when the government spends, in and of itself, that's adding to aggregate demand, that's adding to growth in and of itself. If the person on the receiving end of that decides to spend whatever it is that they receive, that adds to aggregate demand, that adds to growth. But if they decide to save, that is going into the banking system. That is going into the financial system. So not only is government spending creating aggregate demand in and of itself, but the other thing it's also doing simultaneously is it is capitalizing the banking system. So that's really important. Two potential things are happening. You're getting just private sector savings to increase, creating aggregate demand in and of itself when the government's purchasing things. And then if that money is not spent but saved, that's going to enter the financial system as savings, capitalizing the banking system. It's going to be important. We're going to come back to that in just a second. So from an MMT perspective, when the government isn't in a deficit, when private sector savings isn't increasing, when tax receipts are greater than spending and you go into a surplus, you're removing income from the private sector. You're removing the savings from the private sector. You're removing potential aggregate demand. You're removing the capital structure from the banking system. And so that is why Warren Mosler has pointed out in the past, in real terms, when we go into deficit, there is always a recession at hand, or definitely the potential for recession to come. And going back to 1970, where I have this data, every time we had a surplus, this is inverted. I like to look at the deficit as being a positive, the surplus being a negative. So every time we go into surplus, 1970, 1973, 74, 1980, 1981, almost there in 1989, we still had a recession. Obviously, 2000, we had a recession. 2008, we had a recession. Every time, except we're going to come to the big outlier here. Except in 2022, we've had a recession. There's a reason for that, because there's part of the cycle that didn't play out this time that is vitally important. Why we missed the recession, but the key takeaway here is that government spending increases growth. Government subtracting, right? The government taking more from the private sector through taxation or not spending enough decreases growth. That is kind of the first step here. That's the first step that has to be understood. But there is another avenue. There's another channel for growth that can occur that's not just the government spending, because the private sector can go in debt itself, right? There is the financial sector. There is the banking sector. And this is a very key component. If the government isn't meeting the savings demands of the private sector will borrow from itself. The private sector will borrow. The banking sector will create the loans, and that will create the necessary money to allow for the demand to continue. And that's exactly what we saw from, say, 1997, in the mid-90s, as we were getting to that big surplus, up until the dot-com bubble bursted in 2000. We saw a removal of the fiscal spending, and what continued the growth during that time period was the expansion of the private debt cycle. So you have a banking cycle, and you have, we'll call it a government cycle. A banking cycle, this endogenous money cycle. The government cycle, this is the fiscal flow. You have these two cycles simultaneously occurring, oftentimes offsetting each other, right? Oftentimes you'll have the fiscal cycle fire, and then once the fiscal cycle fades away, you'll have the banking cycle kick off, and that will support growth. Eventually, though, and this is kind of where the Austrians are right, eventually that banking cycle will collapse, but it's not for the reasons the Austrians or the mainstream economists have identified. It's not because interest rates get pushed higher and that decreases demand, that makes borrowing more expensive. It has nothing to do with that. In fact, that entire argument is completely backwards. The higher interest rates create demand. They add interest income. They actually, as we're seeing, support growth regressively, but they support growth. What actually happens is that banking cycle, once you remove the fiscal support, that banking cycle can continue in growth as long as the credit expansion continues to accelerate. So we're going to pivot now from the fiscal side to the banking side. And we're going to look at that banking cycle. We'll get back to the interest rate thing. We'll get back how that all ties together. But we need to get another concept in place to understand how these dynamics are working. So the next thing we're going to look at now is the banking cycle, the endogenous money cycle. And I'm going to pull up a program here called Minsky. What Minsky is it's a systems dynamic application that allows you to create stock flow consistent models of the economy. The model I have in front of me is a private sector only, or an endogenous banking cycle only model of the economy that Professor Steve Keen put together years ago. What this is going to demonstrate is that by itself, without government debt, there's no government sector in this, that the endogenous business cycle can produce growth as long as credit continues to accelerate, and that it's when that credit begins to decelerate, when the acceleration begins to fall off, that is when a crisis occurs. And the reason that this is important is that we can see that you can have a banking sector produce the growth necessary, or produce the increased demand necessary to show growth up until a certain point, right? So what ends up happening is you're going to get the fiscal side to pull off, and then you're going to get the banking side to effectively kick in. And it's that banking side now, once that takes over, that if you allow that to continue the growth forward, will lead to the recessions that we end up seeing. So I'm going to go ahead and hit play on this and kind of demonstrate what it is that I'm talking about. And the two biggies here that you want to see is that the debt ratio during the simulation continues to increase. You see the employment rate compress. And eventually, as that debt ratio begins to slow down, and again, these dynamics are contained all within the model, right? This is a purely nonlinear dynamic at play. And you'll see this play out as the simulation runs forward, but eventually the system begins to break down. So the endogenous cycle in and of itself is entirely unstable. I'm going to speed this up and go ahead and let the system collapse. The unemployment rate drops, we get massive unemployment, and the system completely collapses. The growth rates fall off, and you get into a recession. So the reason a recession happens is because you get the removal, as we saw, you get the removal of the fiscal spending that then forces, I'm going to switch back to the fiscal spending here, that then forces the endogenous cycle to take over. There is no support of the endogenous cycle. Credit, by just the very nature of the dynamics that are taking place in the banking cycle, will eventually cease to accelerate. This usually happens above about 150% private debt to GDP. I can pull up that chart on the Fed. You get above about 150% private debt to GDP. You get very sensitive to the deceleration in credit, and then you end up getting a bubble that burst. Again, the main point here is that the credit cycle can be self-contained, separate from any government cycle. But if there is sufficient spending to offset any potential contraction in what I'll call the banking business cycle from the fiscal side, you're not going to get a recession, right? Because of the things that we talked about out of the gate. When the government spends, that creates aggregate demand in and of itself, and it recapitalizes the banks. It allows them to continue to expand their balance sheet. So those are the dynamics at play. Those are the two channels in which you can get growth from. Those are the two channels in which you're going to see play out that can cause a recession. So how does this all tie back to interest rates then? What is it that we are actually looking at, and how does this get into the yield curve inversion? What is the yield curve inversion actually talking about? Now, this is one of the places that I feel Bob Murphy made, a pretty good point. I'm going to go ahead and pull up the yield curve here, back up. And one of the things that Bob Murphy pointed out is that, hey, look, it's this yield curve thing inverting prior to a recession has been around before people noticed it, right? It was a phenomenon that took place before people noticed it. So you can't say that it's some sort of self-fulfilling prophecy. You can't say that it's just traders realizing this and then betting on a recession in the future, because it existed before anyone realized it. So there's clearly some dynamic at play. So it needs to be explained outside of just the behavioral observations of individual agents making decisions in the economy. So what is actually at play here in the cycle that takes place from the inverted yield curve, and how come at this point have we not got a recession to take place? So let's go ahead and do this. Let's start off now and debunk one by one the Austrian arguments, and as we kind of debunk those, let's then fill in the MMT understanding and kind of demonstrate from the MMT side what is actually happening. So the first argument is that there's this interest rate manipulation, right? That the Fed drops interest rates to zero, and that this ends up creating some unsustainable boom in credit markets. What we can do to kind of suss this out is we can use some statistical tools to try and poke at, to try and understand if there is a causal link between the Fed changing interest rates and us getting a expansion in debt. And so we're going to, like I said, we're going to have to do a little data science here to figure this out. But I'm going to kind of walk you through this, and we can kind of see why it's actually the opposite way around, and go from there. So let me pull up my Jupyter notebook here, and what I've done is I've pulled in 3 data series from the Fred database. I pulled in private debt, I've pulled in the Fed funds rate, and I've also pulled in the 10-year Treasury. And what we're going to do is we're going to make a couple assumptions here. We're going to kind of skip a few steps that you would take. We're going to assume that there's mutual information between the two of these. We're going to assume that there's probably some transfer entropy between one variable or the next. So we're going to skip that step. I'm going to say that there's some correlation between these. We're going to assume that there's probably a causal link here. And we're going to kind of skip that step and just kind of take that for granted. And then what we can do, if we can suss out that is in fact the case, is we can take the step to see, okay, which one forecasts which, right? Is there forecastability between any of these variables? Is there an independent variable and a dependent variable on one another, right? Now, there are multiple tools that you can use to determine this. You can use things, if you want to dive into this deeper on your own time, you can use things like reservoir computing. You can use things like convergent cross-mapping. For our sake, though, and I think what is kind of easiest to demonstrate in YouTube world in this video, we're going to use Granger causality. Effectively, what Granger causality is going to do is it's going to look at any given point along the data structure in any data series and see if there's some sort of future causal link there, right? If it's forecastable, that's how the Granger cause stats geeks are going to want me to say it, is the dependent variable forecastable by the independent variable. And we can run these tests to find out then, okay, is the Fed lowering interest rates and therefore creating the credit boom? Or, as I would probably argue it from an MMT perspective, it's actually the Fed who is the monopoly price setter of interest rates. They can set the interest rate wherever they want. They're looking out at the economy and saying, oh, we're getting a boom. We're going to increase interest rates now. That is the MMT story. The Austrian story is the other way around. So we can run our test. We gather our data. And what we're looking for is a chi-squared and an F-score probably below 10. So that's going to be how reliable is our finding. And we're looking for a p-value below 0.05. Those are the two things we are looking for. So we're going to run a handful of tests here. Test 1 is going to be, does private debt cause Fed funds? Now here's the actual test itself, and if you are paying attention at home, you'll realize that Fed funds comes first and the private debt series comes second. And that's because, again, stats nerds like to do things difficult. So how you would actually read this then is you would read this, is Fed funds not Granger caused by private debt in this case? And so when we get a p-value less than 0.05, you would say, no, Fed funds is not caused by the expansion of private debt. Notice the double negative. So what we're looking for is private debt causing Fed funds. If the p-value is below 0.05 and we have a relatively low F-score, chi-squared, we can determine that private debt is causally forecasting Fed funds. There's a causal link there. And we can see that at 1-time lag, 2-time lags, 3-time lags. Once we get above 3-time lags, we start to kind of blow out, and our F-score and chi-squared, the reliability begins to shrink down. And then after that, the reliability, because of the correlation, begins to die down, and we no longer find those valid. But 1 through 3 time lags, we certainly get a positive on the Granger causality. When you're running Granger cause, you also need to run it in the opposite direction. If you get a stronger reading in the opposite direction, then at that point you would want to determine that the opposite is true. And again, we can determine that Fed funds is not causing not Granger causing the private debt expansion. We never see the p-value drop below 0.05. The other thing we can also see beyond just Fed funds, we can also see that private debt is driving the 10-year yield as well, or Granger causing the 10-year yield as well. Now our chi-squared and F-scores blow out very quickly. So pretty much maybe 1 and 2-time lags might have some reliability to them, but after that we get things to kind of blow out there, and then vice versa. The opposite is not the case. So from all the data science that I've done on this, it always shows what MMT effectively argues from pure theory, that the Fed is the monopoly price setter of interest rates. They look out at the macroeconomy, if they see growth driving higher, if they see employment pushing higher, unemployment pushing lower, and if they see inflation coming down, they are going to increase interest rates because they think in their dynamic that higher interest rates are going to slow economic growth. That makes complete sense. And then also traders are going to get ahead of that and say, okay, well, if the Fed is seeing this, then we're going to, and this is, what the Fed is saying they're going to do. We're going to measure things identical to the way the Fed measures it, and we're going to try and get ahead of what it is that we think the Fed is attempting to do. So what we can see and what we can demonstrate statistically is that the MMT argument has kind of the stats behind it. It has the empirical data behind it at this point. Now, this doesn't tell the entire story, and if you're a stats nerd, you're going to definitely be quick to comment in my comment section saying, no, you're overextending what Granger cause is actually trying to say. And listen, I'm not attempting to do that. I'm simply stating that we have a macro theory that we obviously think gives the correct understanding of how the macroeconomy works. We've developed stock flow consistent, nonlinear, dynamic, complex models that show also how the economy works, that emulate what we see in reality. And then when we finally do our data science and the empirical data, it comes back as we would expect. So at this point, kind of the chain of confidence, if you will, says MMT has it right here, right? And this is why, and we're going to go through quite a few more of these various series. This is why you're able to actually make the forecasts that the MMTers were making back in 2022, because we know how this is going to work out. So that's number one. The other point too here with the interest rate manipulation is that in a floating exchange rate regime, the natural rate is zero, right? Anything above zero is actually manipulation. The natural rate would be zero if the Fed never came and intervened and said, hey, we're going to drain reserves out of the banking system to get the interest rate to their target level. They have to actively get the interest rate up. Otherwise, it would fall to zero. Now, again, in a fixed exchange rate regime, that's separate. That's different. But as I mentioned at the outset, we're not in a fixed exchange rate regime. We are in a floating exchange rate regime. So that's another caveat that, going back to that initial point, if you get wrong, you're going to get wrong everything going forward. Now, I'm going to come back to that idea that it's actually raising interest rates as manipulation, because that's going to have some impact down the line. So the next thing is that there is some sort of investment boom once you drop interest rates to zero. But as we can tell, it's not the dropping to zero that creates the investment boom. The reason the investment boom is occurring is going back to that chart that we started off with. It's because during a recessionary period, there are automatic stabilizers. Unemployment fire higher, and that creates a massive fiscal boom following a recession. And what do we talk about at the outset, right? When the government spends, that creates aggregate demand, that gets us out of the initial crunch in aggregate demand, and then it also recapitalizes the banking sector. So two things are happening at once when that occurs, right? Again, we can figure this out from a data science standpoint, right? We can see if this ends up being the case. Now remember, there are many ways that we can suss this out to determine causal links, right? You're going to have to just trust me. We've done it. We've done the work. But even if Granger cause isn't necessarily satisfying every demand you might have to prove this out, at the very least, we have the underlying theory established. We've developed models that show this is how it works. And now we're measuring the empirical data. And so if we don't get a reading that we want in the empirical data, then we do need to go back to the drawing board. But we're going to take it step by step, and we're going to continue to look at it and see, hey, do we need to go back to the drawing board, or does the data keep showing us, demonstrating to us exactly what it is that we would expect to see? So the next thing I want to bring up, I think, to kind of continue to make this argument is we're going to see, does government spending then actually create aggregate demand and lead to GDP? Because we're going to need to kind of piece a handful of these together to make the kind of the larger argument that MMT is attempting to make. So we're going to go back to that. This time we're going to pull in federal deficit and GDP year over year, not the GDP reading. We're going to go year over year. We want both of these to be both year over year. It's the way Granger cause works. You need to do a lot of normalization of the data, but that's what we're going to pull in. So we're going to pull in these two data series, and we're going to see, does government spending create GDP? Is there a causal link between government spending and between GDP growth? And as you'd expect at this point, yes, that is exactly what we end up seeing. Real federal deficit year over year does Granger cause at 1, 2, and 3 time lags GDP. So we see that demonstrated. We do want to look at the other direction, and we do see that there is no detection of Granger cause. The GDP in any way would cause the fiscal deficit to grow. So we can now establish statistically government spending creates GDP growth, and we've established that the interest rate is the Fed determining to set rates higher because they see private debt expansion pushing growth higher, pushing unemployment lower, possibly even creating some inflation in that. That signal makes the Federal Reserve act accordingly by raising interest rates. So we've established now those 2 points. The next point that I want to establish is that also the private debt cycle creates growth in GDP, right? So we're going to see growth out of government spending, and we can see growth out of the private debt. Probably not terribly controversial here, but we do end up seeing, for some reason I decided to reverse these. We're going to go GDP year over year. Does not Granger cause private debt? But if we scroll on down to private debt, Granger causing GDP year over year, we do see at 2 time lags, 3 time lags, the Granger cause coming up less than 5% with a relatively low F and chi-square score. So we can determine that there's reliability there and a causal link. Again, that one's probably not terribly debated, and I probably wouldn't receive too much pushback on that. But again, we have at least established there are 2 channels that are taking place here that are adding to demand, adding to growth, and that these kind of work together in what we end up seeing as kind of the macroeconomy. Quick point here that's popping into my head. I understand too that GDP might not be the best measure for growth here, but kind of for the sake of the argument here, it's what we're going to have to kind of live with for this. The vast majority of my research has all been on equity markets, stocks, financial markets. All this stuff plays out the same in that space, but since we're talking more kind of academic macro, we're going to point this at GDP because that data is readily available. All right. Let's move on then to kind of that unsustainable boom. Let's move on to the bust, and then let's try and tie this all the way back to the inverted yield curve and kind of finish why it is that we never ended up seeing the recession play out this cycle with the inverted yield curve. And I think the last data series that we're going to want to look at to try and figure out if there's a causal link is this idea between private debt. Is there a connection between private debt and fiscal spending, right? Does one cause the other? Do we have the sequence correct in the business cycle? So when we pull together our final assessment, is our sequence right? So therefore we can, hopefully have some sort of confidence in our sequence and then ultimately in our conclusion. So when we run down the series here, what we're going to find out is that there is a very, call it a loose, potentially there signal between the private debt cycle, government spending and the private debt cycle. Remember, the argument was that the government spending is going to capitalize the banking sector. This then allows the endogenous cycle to take off. You remove that government spending, and then the private debt cycle is essentially left to its own dynamics that are at play, and kind of those endogenous dynamics that are at play when we looked at that Minsky model and kind of everything that Steve Keen has spelled out. We do not at 1 or 2 time lags get a score less than 0.05. We almost get there at 3-time lags. And then we do end up getting there at 5-time lags, but what you'll end up seeing is that we do get the F-score and chi-square to get a little bit higher than we would like. So what we're going to say is, yes, we do have a positive Granger cause, but we're going to reduce our kind of overall reliance on this slightly, right? It's not as strong as the other, but we do see a potential causal link here. And this is where other causal tools come into play that we can kind of suss this out. But at kind of face value, it makes sense from an MMT heterodox post-Keynesian understanding that this is how this ends up playing out, right? When we flip it the other way, what we're going to see is that there is, in fact, no causal link. So we've established now, statistically, that it's the Federal Reserve looking out at the market conditions, setting the interest rate based on their backwards understanding of interest rate policy, that they're going to then hike rates, and that will hopefully deter the credit cycle. Of course, we know that doesn't happen. There's no causal link there. We've also determined that we have 2 avenues for GDP growth, right? We have government spending and the expansion of the credit cycle. And we also know that it's the government cycle that effectively establishes then the ability for the banking cycle to take off. So let's piece this all together now, jumping back into the yield curve and kind of make sense of what actually has taken place up to this point. And there are a few kind of other things that we're going to add along the way to really make this a thoroughly robust explanation of what's taking place. So what's happening with the inverted yield curve? You know, again, one of the good points that Bob Murphy pointed out is that, and it's finally an opportunity for me to use my 3D yield curve here, is that when you get the inversion and then you get the sudden reversal of that inversion, it's not the long end of the curve, right? It's not the 30-year bonds or the 10-year or the 20-year, right? It's the short end of the curve that is doing the work during the inversion and then the kind of coming out of the inversion. And so it's very clear that what's taking place is the Fed is making these moves because of what they're seeing play out in the economy. And so the Fed is reading the economy to try and get in front of, as we explained, try and get in front of the business cycle, right? So we can say that, yeah, traders are looking at the entire yield curve, and the yield curve is just effectively what traders think the Federal Reserve is going to do along the time series or along the yield curve itself. But there's going to be more volatility because of various transmission mechanisms on the short end to the long end. I mean, effectively, if I switch this around, what I'm trying to show here is you can see these big peaks and valleys on the short end. The short end is close to us right now of the yield curve, far away, kind of the relatively low variance, low volatility inside of the curve. If anything, the long end kind of turns out to be almost like a moving average of the short end. So it's very clear that the Fed's coming in and doing something, right? And that it's just, effectively just the long end believe the Fed and eventually catches up. So I agree that the reason the yield curve inverts is that the Fed does come in and suddenly jack interest rates up, right? They see the growth that is happening from the initial boom after the fiscal expansion following some sort of crisis, and then as the banking sector begins to take over, right, those eventually kind of hit in succession, and they'll see that boom and they'll say, oh, we got to get in front of this growth lest inflation gets away. And so they're going to raise interest rates into that, right? And so that is undoubtedly where the inversion is coming from. But why does that end up always leading to a recession, and why this time have we not got a recession? And it all comes back to what happened in 2020. Every cycle that we've seen always ends up in that kind of MMT business cycle that I explained. You get this massive fiscal stimulus following a recession. Part of it is automatic stabilizers. Usually a president wants to come in, say something, get more votes, not tick people off, so they're going to increase fiscal spending. And eventually, just because of the way the fiscal spending cycle kind of plays out, that rate of change dies off. You end up getting higher taxes. That decreases the spending. The business cycle, the banking cycle begins to take off as well. That increases taxes. You end up getting kind of bracket creep. So the government spending, the deficit gets smaller and smaller. Maybe you do get some inflation during that point in real terms. Then the deficit begins to decrease and the cycle plays out again. You get a bust, then you get the boom. And it's this interplay between the fiscal side and the banking sector. And we saw that play out prior to every single recession. But something quite peculiar played out prior to the most recent cycle, the downswing that we saw in 2022. We had a massive fiscal cycle. Private savings was still kind of chock full post-stimmy check, right? And so we have this massive fiscal cycle that then did give way into, in real terms, a surplus as deep as we've seen since the dot-com bubble. But there was still enough fiscal spending that we never ended up getting the immediate negative impact of enough kind of latent fiscal spending that took place in 2020 and 21, that the immediate impact of the surplus wasn't felt. The other thing, and this is the biggie, the other thing is every other time, what does the Fed begin to do as it sees a slowdown in the economy? We explain this every time it begins to suss out that slowdown. Remember, that slowdown happens endogenously. We saw that using the Minsky model. The endogenous cycle will play out. You will see, once you remove the fiscal spending, you will see the endogenous cycle roll over out of its own accord, right? The Federal Reserve senses that. They see that in the data. They see a potential slowdown in growth, and they think, okay, we've slowed down inflation, but they didn't. It wasn't the higher interest rates. We'll get to that in just a second. We know it's not because we're seeing it play out. No, what they're seeing is the endogenous cycle do what it does, right? They're seeing the countercyclical spending that takes place during the federal side, right? Because of the higher taxes coming in. It senses that slowdown as that slowdown essentially gets priced into the macro data, and it decides to take its foot off the gas on the interest rates. It actually sometimes will even bring interest rates down to zero to try and fend off a looming recession. And you see that with the inversion of the yield curve, that it's not the inversion of the yield curve per se that's causing the recession. It's as the Fed brings the interest rate down to zero, that collapses the economy. And that never happened this time. It didn't happen in 2022. I agree. We had all the dynamics at play for a recession. We had a banking cycle rolling over in 2022. At the same time, the fiscal side was also rolling over. Largest tax receipt ever in 2022. We had both those things play out, but what the Fed wasn't doing is dropping interest rates to zero. Why? Because they were too focused on the risk of inflation. And because they have the interest rate thing backwards, we'll get to some more details on that in a second. I realize this video is going long. I promised it would. But they kept the interest rate high. What does that higher interest rate do? It adds additional interest income to the private sector. So we're going to go all the way back to the beginning and notice the sudden surge of additional interest income to the private sector right after the contraction. The contraction lasted very shortly, only a few months, right? That's why we had bad year in stocks in 2022. But that's why every MMTer who understands this was saying, no, get long the stock market. This is going to be the biggest surprise to the upside because the Fed has it backwards. It adds additional interest income to the private sector, and we are seeing acceleration effectively on the fiscal side as though we were in a recession. And it's offset any negative demands that the banking cycle would have had. Had the Fed read 2022 as potentially deflationary, took their foot off the gas, brought interest rates to zero, we would be at a recession. We would be in a recession right now. It would absolutely collapse the banking sector, right? We would be getting what it is that they wanted. But thankfully, they're idiots. They don't know what they're doing. They've got it all backwards. They haven't listened to Warren Mosler, right? They haven't listened to me. They haven't listened to the MMTers. They got it backwards. And what do? They just flooded the private sector with additional interest income. Now, I know there are some people right now saying, wait a second. I'm not buying this. You're going to have to kind of explain this additional interest income to the private sector. We know that higher interest rates decreases demand and yada, yada, yada. So I'm going to kind of finish this video on that point. We're going to go over this sequence and why this all works out. And hopefully, I made a post on this a while ago, but hopefully you now have the entire framework properly established so you can understand what each one of these steps means, right? And why we know that this is exactly how it plays out. Remember, we've done the work. We went to the lab, we ran the data, we've done the work, we know what the causal links are, and we know that what I'm about to go over, what I posted on Twitter a couple months ago, right, that this is how it all plays out, or a month ago, this is how it all plays out, and we can see this entire connection, right? We can see this entire circuit and why each of these causal link and why ultimately this inverted yield curve is not leading to a recession. It's not going to, unless we get some sort of outside shock to the system that massively decreases fiscal spending. We're not going to see a recession. And I'll kind of lay out how we maybe could get a recession, but at this point, it's not happening. So let's go over this entire cycle. The first thing is the Fed just increases interest rates. That's the very first thing. They hike interest rates. And then from there, and that's going to add the additional interest income to the private sector. And then from there, what that's going to do is that's going to increase the price structure of the economy. Now, this is where most people stop. And because they have the interest rate thing back, I'm sorry, not the interest rate thing, right? But because they do not understand endogenous money, right? Because they think that we still, for whatever reason, operate in a loanable funds world. For the love of God, we are not in a loanable funds world. Right? The reserves are not lent out. The money multiplier, that's all great stuff in a fixed exchange rate model. Like, by all means, if we go back on a gold standard, use those terms, understand things in that way. It's not. Loans create deposits. End of story. That's how it works in a floating exchange rate regime. You have to understand it that way. So this is where the miss ends up happening. You do get an increase of the term structure prices. Things get more expensive. I agree with that. But that does not dampen demand. And the reason for that, we're going to jump to the fourth and go back for the third, is that additional interest income finds its way into the private sector, and the private sector wants that. So even if you might make an argument like, hey, this is all saved, right? All this money is saved. It's low propensity to consume. It's just given to rich people. That's right. Higher interest rates are regressive growth. MMT calls for a 0% interest rate because they think this should all be coming from the fiscal side. It should be bottom up, not top down. It should be trickle up, not trickle down. But we are actually seeing trickle down. And two things will happen. One, we end up seeing if it's saved, right? If the money just going to rich people and it's saving, right? We already talked about what happens then. That goes into the private or the banking system. That's private, capitalizes the banking system and allows for expansion of the private net cycle. I think what we're seeing right now is actually a lot of that is getting spent, right? One of the things we've seen is the reservation wage, that is the wage that people are demanding if they're going to take a job, skyrocket. We actually see a correlation, we'll call it. I don't know how strong the correlation is, but there's definitely a correlation between rates and this reservation wage, right? So we see the higher term structure prices, and then the private sector senses, hey, crap's getting more expensive, right? But and I'm going to demand higher wages so I can afford higher stuff, or I can, get the house, that sort of thing, right? I know if I want to get a new house, I know that the mortgage is going to be higher because I understand term structure prices. So I'm going to demand a higher wage. And so one of two things is happening. I mean, either one, some of the rich are obviously just going to be saving that money, but that capitalizes the banking system. Two, we'll call it the bottom 50% or whatever it is, right? But the non-rich, those who aren't benefiting from the additional interest income, right? They're demanding that higher wage, but it's there to give, right? The additional income is being supplied to the private sector via the channel of the higher interest rates. I mean, the transmission is there. So you're not seeing the decrease in demand. And this is what most people miss, right? This is the first thing that most people miss. And so just because prices are higher doesn't necessarily mean that that's going to decrease demand. It's an income. It's an income function. It's a function of the income. And the income increases with additional interest income to the private sector. Loans are not determined because of interest rates. Loans are determined because of income. When you go into a bank, they're not looking in the vault seeing what reserves are. The only determination they are making, they have two things that they have to think about. Thing number one, what is the income of the person that wants this loan? Thing number two, what is my capital structure and am I meeting regulatory compliance? Those are it. Income. That's what matters, right? And if those regulatory considerations get in the way, they can change those, and they will, right? They will. It's the income that matters. And so that income is there, it's supplied, which meets the higher price structure. So that is how this all ends up tying back. It creates the necessary job growth, and then it only cycles back. The Fed sees, oh God, inflation's still pushing higher, and job growth continues to grow. We have a hotter than expected economy, and then what do? They hike interest rates again. And that is the cycle now that we are effectively stuck in. That is where we are at. So it all comes back to the fact that all the way back in 2022, when we could have been in a recession, the Fed decided not to lower interest rates. Had they lowered interest rates, what would have happened? What would have happened, right? We would have immediately seen the additional interest income to the private sector wane, right? Interest rates at zero, no additional interest income head into the private sector. We would have seen the term structure of prices flatten out, right? And then here's the kicker. We would have seen demand for that flatten out. And this is where lowering the interest rate to zero actually creates the collapse. If we go all the way back to the Minsky model, one of the things that we need is accelerating. We need accelerating growth to continue that cycle higher. But when you take away the additional interest income, you're effectively now taking that growth. The taxes start to increase on the surplus, and you're taking that growth away. You're effectively now putting an immediate cap on how far this system can continue before the dynamics play out and you get a crash. The other thing you're doing too, and this is kind of for the Minsky geeks out there, right, for the heterodox crew, you're also slowing down the turnover, the velocity of money in the economy. So you're getting a double whammy against growth when you drop interest rates to zero. And we already saw there's no causal link. We did the math. There's no causal link between lower interest rates and more loans. It's an income thing. That's what's driving the loan growth. It's an income thing. That is the causal link. And the income continues to accelerate. So, putting a bow on this one. Been a very long video, but we have hit, I think, everything we could to really and fully demonstrate this, while also debunking some of the Austrian myths, and finally concluding why it is that we are just not in recession, why this time it truly is different. So how do we end up in a recession? How do we end up in a recession? The way that we're going to end up in a recession is if the Fed decides to drop interest rates to zero for some reason. I think the only way that this is going to happen is if we really start to see something like oil really, really take off, right? Because if oil takes off, in real terms, we might start seeing deficit spending take a hit, right? But I think we would probably need above 200 oil for an extended period of time for that to end up being the case, right? Maybe you get some situation where you get these kind of dynamics play out where the bottom 50% gets squeezed so hard because of the dynamics at play here that maybe that gets to be some sort of signal that the Fed needs to take their foot off the gas. But until something like that plays out, it's we are light years away from a recession. So we would need to see a dramatic decrease of fiscal spending in real terms, whether that be just because oil really begins to skyrocket or the Fed decides to really take their foot off the gas for some reason. That needs to play out. We need a flattening of the dynamics at play with regards to the interest rate and how that's playing out. Maybe then we could get a recession. But as it stands right now, in July of 2023, that doesn't seem like a likely event. If that does play out, then yeah, we'll get a recession. That's fine. I'll become a bear, and I'll be out there tweeting to everybody that, look, we're going to get a crash, we're going to get a crash. But until that takes place, we're not going to get a crash. So that is the kind of full explanation here of how to understand the business cycle from an MMT perspective, why the Austrians have it backwards. We even kind of touched a little bit on why kind of the Monetarists, the Neoclassicals, why they got it backwards, and why really only MMT understood this happening, right? Because only MMT started from the correct place. They started from the fact that we are on a floating exchange rate regime, and we built from there. That's what Warren Mosler realized 30, 40 years ago, and that's how this entire process began. He realized that one fact, that so much of economic theory is based still on a fixed rate regime system, and so they get everything wrong at every point. So that is the MMT story. I hope this was helpful. If it was, make sure you get subscribed. Hit the like button. I put a lot of effort into this. Turn that notification bell on. Now listen, as I mentioned, a lot of my research is on markets. If you're an active trader, active investor, this sort of approach, this sort of deep dive into the data, this sort of applied MMT approach to investing or trading, if it would be helpful to you and you're interested in joining our team over at MMT Macro Trader, check out the Patreon, patreon.com/MMT Macro Trader. You can get access to multiple reports each week that are focused on markets. Other than that, I'm going to go ahead and wrap things up here. Before I go, let me know in the comment section down below your thoughts. I probably missed some points. I probably could have explained things a little bit better. You probably disagree. By all means, give me your best rebuttal if you're on the other side. But until then, as always, good trading, everyone. We'll talk to you next time. Bye-bye.